Welcome back to our channel. Today we're talking about something that might completely change how you think about retirement planning. Here's a question for you. What if I told you that one of the most powerful retirement planning tools isn't actually a retirement product at all? Retirement Reimagined: How Life Insurance Creates Tax-Free Income. Most people I meet have the same retirement strategy: max out your 401k, maybe contribute to an IRA and hope for the best. And that's not bad advice, but there's a problem most financial advisors aren't addressing: taxes. Here's the problem. When you withdraw from your 401k or traditional IRA in retirement, every dollar is taxed as ordinary income. That means a $50,000 withdrawal could leave you with just $37,500 after taxes. So here's the million-dollar question. Do you think tax rates will be higher or lower in 20 years when you're ready to retire? With our national debt growing and demographic shifts putting pressure on social programs, many experts believe tax rates have nowhere to go but up. Today I'm going to show you how properly structured permanent life insurance can create a stream of tax-free retirement income that gives you more control and potentially better after-tax results than traditional retirement accounts alone. Next, we'll look into the retirement tax problem. Let's start by understanding the tax problem most retirees face. Most retirement planning focuses on the middle bucket, tax-deferred accounts like 401ks and traditional IRAs. You get a tax deduction today, but pay ordinary income tax on every dollar you withdraw in retirement. The problem is, you have no control over what tax rates will be when you retire. If rates go up, which many experts predict, your retirement income could be significantly less than you planned. For looking at history, today's tax rates are actually relatively low. In the 1970s, the top marginal rate was 70%. In the 1950s, it was over 90%. I'm not saying we'll return to those levels, but it illustrates how tax policy can change dramatically over time. This is why tax diversification is just as important as investment diversification. You wouldn't put all your investments in a single stock, so why would you put all your retirement savings in accounts with the same tax treatment? Ideally, you want money in all three buckets: taxable, tax-deferred, and tax-free. So you can strategically withdraw from different accounts based on your tax situation each year in retirement. And this is where permanent life insurance comes in. As one of the few vehicles that can provide truly tax-free income in retirement. Life insurance as a retirement vehicle. Now, I know what some of you might be thinking. Isn't life insurance just for the death benefit? That's certainly its primary purpose, but properly structured permanent life insurance, whether whole life or indexed universal life, can do much more. Unlike term insurance, permanent policies build cash value over time. This cash value grows tax-deferred, similar to your 401k, but with a crucial difference in how you can access it. When structured correctly, you can access your policy's cash value through policy loans that are completely tax-free. This isn't income in the eyes of the IRS, it's a loan against your policy's cash value. Let me show you how this compares to traditional retirement accounts. With a 401k or traditional IRA, you get a tax deduction when you contribute. Money grows tax-deferred. All withdrawals are taxed as ordinary income. Required minimum distributions start at age 73. Early withdrawals before 59.5 face penalties. With a properly structured life insurance policy, contributions are made with after-tax dollars. Cash value grows tax-deferred. Policy loans provide tax-free income. No required distributions. Access when you want, no age restrictions on accessing your money. The key is in how you structure the policy. You want to minimize the death benefit relative to the premium, what we call a minimum non-EMEC design. to maximize cash value growth while still maintaining the tax advantages. When you take a policy loan, you're not actually withdrawing your cash value. You're borrowing against it, using it as collateral. The insurance company gives you the loan from their general account, and your cash value continues to grow as if you never took the loan. This creates a powerful tax arbitrage opportunity that simply doesn't exist with traditional retirement accounts. Now let's talk numbers. Let's look at a real example to see how this works in practice. Meet John and Lisa, both 45 years old. They're maxing out their 401ks but are concerned about future tax rates. They have an additional $20,000 per year they can save for retirement. Let's compare two scenarios over 20 years until they're 65. Scenario A, they put $20,000 annually into a taxable investment account, earning 7% annually. Scenario B, they put $20,000 annually into a properly structured IUL policy. After 20 years in Scenario A, their investment account has grown to approximately $820,000. But when they start withdrawing $50,000 annually, they'll pay capital gains tax. Currently 15% for most people, but potentially higher in the future. In Scenario A, their investment account has grown to approximately $820,000. But when they start withdrawing $50,000 annually, they'll pay capital gains tax, currently 15% for most people, but potentially higher in the future. In Scenario B, their policy's cash value has grown to approximately $750,000, slightly less than the investment account because of insurance costs. But when they take $50,000 annually as policy loans, they pay zero taxes. Even if capital gains rates stay at 15%, John and Lisa would have more after-tax income with the life insurance strategy. And if tax rates increase, the advantage becomes even greater. Let me walk through another example, this time comparing with the traditional IRA. If you contribute $10,000 annually to a traditional IRA for 25 years, earning 7% annually, you'd have about $675,000. But every dollar you withdraw will be taxed as ordinary income. At a 25% tax rate, your $50,000 annual withdrawal becomes $37,500 after taxes. With a properly structured life insurance policy, funded with the same after-tax equivalent, about $7,500 assuming a 25% tax rate, you might accumulate around $525,000 in cash value. But your $50,000 annual policy loan comes to you completely tax-free. Is this right for you? Now, let's be clear. This strategy isn't for everyone. Let me walk you through who might benefit most and who should probably look elsewhere. This approach tends to work best for people in their 30s to 50s with 15 plus years until retirement. Those who have already maxed out traditional retirement accounts. High-income earners concerned about future tax rates. Business owners and professionals with variable income, those who value flexibility in their retirement planning. This may not be the right fit if you're within 10 years of retirement, not enough time for cash value growth. You haven't yet maximized your employer 401k match, that's free money. You have high interest debt that needs to be addressed first. You don't have stable, consistent income to fund the policy. You need all your savings to be liquid in the short term. It's also important to understand the limitations. These policies have costs that reduce returns compared to pure investments. They require disciplined, long-term funding to work effectively. Policy design is critical. A poorly structured policy won't deliver these benefits. You need to work with an advisor who specializes in this strategy. The tax advantages depend on current tax laws, which could change. The key is to view this as part of a diversified retirement strategy, not an all-or-nothing approach. Most of my clients who implement this still maintain traditional retirement accounts and other investments. So let's recap what we've covered today. Traditional retirement accounts create unknown future tax liabilities. Tax diversification is just as important as investment diversification. Properly structured permanent life insurance can provide tax-free retirement income. This strategy works best as part of a comprehensive plan, not in isolation. Policy design and implementation are critical to success. If you're intrigued by this concept and want to see how it might work in your specific situation, I've created a free retirement income calculator that you can access through the link in the description below. I'm also offering complimentary retirement income strategy sessions for the first 10 people who comment tax-free below and schedule through my calendar link. Book your session through the link in the description. In our next video, I'll be diving deeper into exactly how to structure your policy for maximum retirement income, including which riders to add and which to avoid. Make sure you're subscribed and have notifications turned on so you don't miss it. And if you found this information valuable, please give this video a thumbs up. It really helps the channel. Thank you for watching, and I'll see you in the next video.